Welcome to today's presentation, where we have the pleasure to present the Sampo Group. To help us through today's presentation and answer questions and present the 2024 result and the main achievements this year, we are joined by Head of Investor Relations, Sampo. As always, you're very welcome to ask questions down in the box down below. We actually think it's much nicer to go to a lot of the presentation or to Q&A, so we will have some focus on that. But for now, I think I will hand the call over to you, Sammy, and congratulating on what looks like a pretty solid results here in Q4.
Thanks, Michael, and I would obviously agree with you. And I'll take a sort of high-level overview first, and then I'll dive into a couple of parts of the result that I think were particularly interesting. Probably one of the most notable areas of the result is the strong growth that we have, the strong top-line momentum that we have. And it's not the first time we've done this now. We've had a couple of years now where we have really, really strong top-line momentum in the business. And it's coming from actually quite broadly within the group, where we're managing to execute on some of the strategic initiatives that we have, and where we're benefiting a lot from the footprint that we have in the UK. And a lot of it is actually coming from non-motor lines. But I'll get back into some of that in a minute. Now, does that mean that we've lost our head and forgot about underwriting discipline? No, of course not. That's very much still part of our culture. We have solid margins and improvement in the margin year on year, and at the headline level, so the numbers that you see up front in the report. But also, if you strip out all these sort of slight ups and downs that you get every quarter in P&C insurance and look at the more underlying level of margins, you can also see that that's trending positively, broadly at a similar level to what we've seen earlier in the year. So the business is sort of ticking along in line with plan. I'll get back to the UK in a second, but now maybe briefly on capital returns as well. We've suggested a regular dividend of 1.7 euros per share, which will be after the share split 34 cents per share, but 1.7 based on the current share count, and that's an increase of 10 cents on the previous year, 6%. So it's a sort of solid, robust, reliable increase. Again, I'll touch on that in a moment. If we look at the operating EPS, we're up 13% year on year. Remember, we have a target here of increasing operating EPS by 7% on average over the 24 to 26 period. So this is pretty strong progress against that target. All right, let's dive into a few of the particulars in the result. And I want to start with this slide because I think it's super important, and I think it comes back to this theme about organic growth. Remember, our agenda, our strategy is very much centered around organic growth. We have an excellent footprint with being the market leader in the very stable Nordic market and being more in a challenger digital position in the UK, where we do have a sizable business in the UK, but it's a business that can take market share over time and still become much larger. And we can see that the areas where we've really invested in the business to improve our proposition, to make ourselves even more relevant to customers, not just by the product, but also by how we reach the customers, which is increasingly digitally, we can see that that's paying off. So in the Nordics, and before I go into that, actually, about half of our portfolio is composed of these areas in the Nordics where we're focused on growth, and the UK together. So about half the business is areas where we think that we can grow very attractively. In the Nordics, we're talking about things like personal insurance. I think I've talked about this before, but remember, as the sort of welfare state pulls back a bit, there's an increasing need for personal insurance, and we're able to fill that. Private property, we've been traditionally a little bit underweight in private property in some areas across the Nordics, and we're fixing that. And having the increasing digital penetration is really helping with that. And then the insurance for small and medium-sized enterprises. Again, here with digital technology, you're able to do this in a much more cost-efficient way and in a different way to what these small companies have been served as before, or not served as before, as is often the case. Then in the UK, We've had a situation where pricing has come down a bit over the year in the UK motor insurance market. And that added level of competition, we think, is actually largely a rational reaction to developments and claims trends. So the companies are passing on savings on the claim side to consumers. But it has also meant that it's become a little bit more difficult to find growth opportunities. Nonetheless, we've been able to find selective growth opportunities in the fourth quarter, and not as much as in Q3 when we grew lots, but we still added 84,000 customers or policies, in the fourth quarter, largely driven by these slightly more niche areas like bike and van insurance, telematics, which is becoming a big product in the UK, and of course home insurance, where we continue to grow. So if we look at the right-hand side here, you can see that these target areas, which are really adding to this light gray base bar here and pushing up the organic growth rate to 10%. And then we had the acquisition of Oona Health last year. That takes us all the way then to 12% once we include M&A. Very solid growth rate. If we look at our outlook then for next year, we expect to be able to continue to grow strongly also next year. We're forecasting 47% premium insurance revenue growth, which is a slightly different metric technically to this GWP, but we're forecasting a solid continuation in organic growth there. Promise I won't take this long over every slide. That was just the most interesting.
Oh, no, that was an important slide.
And this one I'll be briefer on. On the commercial side, so this is the insurance we sell to companies. And this slide is mainly about slightly bigger companies, actually. A lot of them buy their insurance on the 1st of January. It's a big renewal state, as we call it in the industry. And we're saying here that it's gone very well this 1st of January this year. So we've seen a strong uptake of our product. We've been able to get through the price increases that we need to take, and we've been able to continue to do that whilst retaining a very large share of our customers, around 90% or even a bit more. Moving then to some other specifics. One of the things that gives us the confidence to be optimistic about next year is that we're seeing a very rational market across the Nordics. Particularly actually in Norway, where there's a number of companies that are still catching up with the increase in claims cost that we've seen as a result of elevated claims inflation over the last few years. So the Norwegian market has been worse affected by this than some of the other markets. Insurance companies have had to play catch up a little bit, or some insurance companies have had to play catch up a little bit. We were very early to increase prices in Norway. And to adjust terms and conditions and position ourselves for this increase, which has meant that we've been able to deliver very solid profitability, but also start adding more customers. So we can see on several metrics here on the slide that we're adding customers, and that we're particularly doing it through the digital channel. Top Denmark, I don't have much to say on Top Denmark this quarter. The integration is going very much in line with plan and very well. The only update really is that we've taken a charge of 150 million, which is basically investments that we're going to make into realizing the synergies in the company. Now, something that's closer to, or very close at least, to shareholders' hearts, capital returns. We are we know that that's a really important thing for our investors, and we're very focused on being disciplined on capital management. And I think we have built a very strong track record around this. This quarter, as I mentioned, this year, we have a regular dividend of 1.7 euros per share. And that's a good level. It's a 6% increase from last year. It's a payout ratio on operating earnings per share of about 73%. And that's a little bit lower than where we would be normally, actually. So what we're also saying today is that we expect to launch a buyback later in 2025, partly funded by the money that we made last year, and partly funded by a potential sell down in some of these legacy holding company investments that we have, and I'm in particular talking about Nova, the Swedish consumer bank, where we still own a stake, and we're hoping to be able to partly exit that investment later in the year, but there's no certainty around that yet, and that's going to depend on market conditions. We'll come back to the buyback at some point in the second quarter, most likely, once we get, first of all, a new mandate for a buyback from the AGM, and then hopefully some more clarity around these issues as well. We've said that we would update on buybacks about once a year, and we expect buybacks to continue to be a sort of fairly recurring part of our capital distribution. Finally, then, a couple of words on the outlook. And as I hope you've picked up from my spiel here, we're entering 2025 with very strong business momentum, particularly in terms of organic growth opportunities, but also in terms of being able to continue to deliver the stable and reliable margins that we have, and being able to improve those a little bit, particularly through efficiency measures, but also through good underwriting. Now, I already talked about the revenue, so let's not go through that again. But on the underwriting result, which is the profit that we make as a difference between premiums and claims and costs, so premiums less claims paid, less costs, that's the differential, the 1.35 to 1.45 billion. And that's coming, as you can see from the numbers here, we're looking for a 3 to 10% increase. That's coming mainly from revenue growth. The biggest part of that 10% comes from revenue growth, but we also hope to still continue to make some improvements on the margin side, as I alluded to. These and if we zoom out, then, so that was for the outlook for 2025. If we zoom out, then our ambition is still to deliver at least 7% operating EPS growth on average for the 2024 to 26 period. So for a couple of years still, and then also to keep our stable, disciplined margins with a combined ratio, so a total cost ratio in the insurance business of less than 85%. And that brings us to the Q&A.
Perfect. I have one question, just to understand it, maybe some other also from the audience. You're guiding 3 to 10% group underwriting results, and you say operating EPS will grow 7%. Can you combine those two? Let's see, you have 3% potentially, and there's a question also about the right range. We can take that later on. Is that the investment income that will and taxes and so on, that even if you should hit in the bottom range there, you are still comfortable delivering 7% on the operating EPS? I don't know, did I ask the question right?
Yeah, no, you did. No. That's a fair question and a good question. So if I start with the number, the 3 to 10%, and explain how we think about that, we are at the higher end, so 10%. We're thinking about a year where we execute well, but where we don't have any luck on things like weather or big fires or stuff like that. But that kind of comes in as we expect, but we're executing well operationally. We have had traditionally a way of guiding reasonably conservatively as a company, particularly at the start of the year. So this is maybe slightly different to how you do outlooks in Denmark, for example. But Sampo has quite a long-standing track record of guiding quite conservatively. The only thing really that's new about this year is that we're using slightly different KPIs to what we've done before. Usually we've guided on margins. Now we're guiding on the profit number or underwriting profit number.
Yeah.
So we're obviously, if to get to the 3%, then we are having bad luck. So to bring us back then to the 7% target, technically that doesn't apply annually. I'm not saying that we can't get to 7% this year, but technically it's not defined as such. There are other moving parts as well, but it is really the underwriting result that we expect to be the driver of increases in operating EPS as well. That's what we're fully focused on delivering, and if we deliver towards the upper end of our guidance range, I think we're well positioned to deliver operating EPS above 7% as well. Then we have a little bit of headwind from all these new shares that we got as part of the Top Denmark transaction, where our share count is going up a little bit as a result of that year on year. But that's a more technical matter.
Yeah, but that makes a lot of sense. That when you do a fixed number in an insurance company, instead of saying it's adjusted, adjusted combined ratio that is easier to control, then it makes, of course, a lot of sense in the start of the year to have a wider range. So thank you for clarifying that. And then on the UK side, and then I'll jump into the question from the audience. The UK say, I think you indicated that it's a healthy price slowing down and not a competitive pricing. And I know, if you understand what I mean, it is the claims inflation coming down, and that's what you're seeing, not that there is a increased competition or people are again aiming for growth, because I guess it's a kind of competitive market and you are fighting in the price comparisons. So it must be important for you to be sure that it's the claims ratio coming down and not a competitive pressure. So you are pretty comfortable that is the case.
Yeah, I mean, just to be clear, the UK is always a very competitive market. So it's not like we're lacking in competition. You can see that from things like there was a regulatory change in the UK in the autumn where that basically meant that very severe bodily injuries became a little bit less costly. And then there was the price of reinsurance has come down as well. Yeah. So the insurance that insurance companies buy to protect themselves, protect their own balance sheet. And those benefits have been passed on super quickly to consumers, as they should be. Our focus, we have a clear target margin in the UK that we need to make an attractive return on capital. And we focus on, we don't focus on exceeding that target margin. We focus on being as much in the middle of that as possible. Why? Well, because that wins us as many customers as possible, and that increases our underwriting profit as much as possible. So
and the reason for that is that you actually have potential to cross-sell to those customers because you are new in the UK market.
Well, the number one reason is that in the UK, the consumer is very price sensitive. If you reduce prices by, and this is an approximation now, if you reduce prices by 1%, you gain about 5% more customers. That's roughly the relationship. That's not the same in the Nordics, but in the UK, where price, and it's important to understand here that we sell via price comparison websites. It's basically a list of insurance policies with the cheapest one first, and so on. So you need to be at the top. What we're not seeing, so it's competitive, but what we're not seeing is sort of rogue actors coming in and undercutting. We're seeing the same. We're seeing, market-leading companies, good competitors like us, being very, accurate with their pricing and passing on benefits to consumers and focusing on hitting their target margins and focusing on adding customers to their portfolios.
And I guess your combined ratio in the Hastings business is actually the proof in the pudding. Of course, you can be a little bit ahead.
Yes.
Then there's a question: how sensitive are you to 25? How sensitive are your 25 expectation of interest rate changes, particularly if rates fall more in Europe than market expectation, both on your investment income and in generally on your business? There is a discussion right now as you know, in Europe, you are in Europe, that maybe we need to go lower to kind of push up the economy.
Yeah, it's not super sensitive, the outlook, to be fair. There is a little bit of sensitivity in there, but we've already assumed that, that interest rates are going to come down. We can see the expectations as well. So we've baked that into our forecast to a large degree. Now, if we saw a fall that was significantly more than expected, then we would need to think about the impact on.
But it would have a slightly negative effect, even if you're winning on your investment income, but your operational business would suffer a little bit from it.
It depends also how the interest, and I'm getting very technical here, but it depends on how if it's just the short end, so the base rate coming down, that doesn't really change so much. No. For us, it's more like the 7+ years. So bonds with a duration of more than 7 years that become important there. The shorter rates, however, are more important actually for our investment income, which is not included, by the way, in this underwriting profit.
Yes.
If we saw a collapse in short-term rates, then we would make less investment income. It would take a year or two for that to make its way into the P&L. But naturally, over time we reinvest our bonds, and they would be reinvested at lower rates.
Perfect. Have you seen any customer outflow from Topdanmark after the takeover?
Not anything significant. Actually, one of the things that I didn't point out in my spiel, but I think I should mention now, since you asked the question, is that in Denmark we've had in Topdanmark we've had very good growth momentum. If anything, we've actually seen growth increase quite significantly over the year. So we were sort of at lower rates in the first couple of quarters. Then we got to 8% GWP growth in the third quarter, and then to a full 11% actually in the fourth quarter. And we're seeing that come from pricing and from positive net customer inflows. So we've seen the Danish market be quite a little bit similar to Norway, but not as much. We've seen the Danish market correct for higher claims costs, particularly in the motor business, where the average cost of a repair has gone up quite a bit over the last few years.
I believe you have just been to the repair shop. There was this white guidance range. I think you explained that very carefully, that in the start of the year you need to take into account that you can have large claims, you can have big weather claims, and so on. So that is the main explanation for the wide range you have on the underwriting results growth.
That's right. I mean, we're still in February here, so at least here in Finland and in Sweden, parts of Sweden, we've got another 2-3 months of winter to come. So there's still some uncertainty there.
Perfect, thank you. And then there's a question, and I think you also answered that, but I will ask you, how big a share buyback program will it be for 25? But I guess you kind of answered that. We will hear that later.
Yeah, let's. We haven't put a number on it yet.
No.
And interesting that we get asked this here actually, but not on the analyst conference call. So you've got some very informed questioners here on the line. But I guess the way I would think about it, or one way to think about it at least, is we have a solvency ratio at the end of the year, so including all the earnings from last year, of 177%. The midpoint of our target range is 170%.
Yeah.
That difference, the 7 percentage point difference, is a couple of 100 million euros. So that's when I talked about using last year's capital generations, the money we made last year for the buyback. That's the baseline. Then I also mentioned,
and that includes your dividend already paid out. Is that correctly?
So the couple of 100 million, that's excluding the dividend. So
but in the calculation of the 177, there's nothing to do with the dividend. So new cash coming in could increase that during the year.
Absolutely, yes. The dividend is already reflected there. So that's the law. That's Solvency II.
I know. I just wanted to make sure.
No, it's a good question. But then just coming, so we've got a couple of 100 million to work with there, and then euros. Then we have this stake in Noba, and there's been some talk about an IPO of Noba later in this year. Let's see. IPOs are always uncertain. It's going to depend on market conditions. It's going to depend on a lot of things. But if we manage to exit that, we have a book value on that investment of about 400 million euros. Obviously, in an IPO, you usually have to sell down in stages. So let's say we manage to exit half of that, you get another couple of 100 million. So that's the range. But we'll have to. Then things can happen during the year. You never quite know exactly how it plays out. But that's the sort of numbers that you can think about.
You can think about that. That's perfect. Then there's a question. What is the reason for doing the share split right now? Normally you should cross 100 in the US and so on. So has it anything to do with the integration of Top Denmark or the purchase there, or is it simply a decision to keep the price down so as many investors can actually join your journey?
The main reason for this is that we tend to take quite a retail-friendly approach. We do things like this. We do quite a lot of other retail things as well. And we try to have a good dialogue with our retail shareholders. And one of the things that we have been requested a lot is that we do split the stock. I think not that our stock price is like silly high or anything, but it's quite a bit higher than most other Nordic financial companies.
Yeah.
So that's, it's not a huge change or something that I would overstate the importance of, but that's the main reason. Then you can get positive benefits to liquidity, particularly on the exchanges where we have a big share of retail trading, so Denmark and Stockholm. But hey, let's see about that. That's an answer.
But it is, and I know, of course, not everybody just have 5,000 to put in, so actually share costing something matters for some people. We must sometimes also admit that. So, no, it was just wondering whether there was some technical issue, but it is a part of you being shareholder friendly, and you have done it before. Is that correctly understood? The share split.
I have to admit that during my time of following Sampo, which is since about 2010, I don't think we have done a share.
You haven't done it. Okay.
But Top Denmark has done some stock splits in the past.
Yeah. Perfect. And then finally, you have strong underlying growth in Q4. What is driving that? I think you touched a little bit upon it, but if I understood you, it was maybe a hard question because it looked a little bit broad-based.
Let's go back to this slide that we had on it. And it was quite broad-based, that's true, which is obviously, it's always great to see a broad-based growth rather than being reliant on one thing. But if we look again on this top right here, the bars, we've got a base growth. So the portfolio excluding, if we look at this pie chart, the gray stuff here, which is, it's not, to be clear, this is not business that we care a lot about. It's all core business. We don't have any non-core business or anything like that. But it's areas where we already have quite a high market share or a strong market position, or there's some other reason for why we're not quite as growth focused. Whereas then the other half, which is all the lovely colors here, we have more of a growth agenda. And if we then go back to the top right-hand chart here, you can see that it's actually these areas with the colors that's bringing up the organic growth rate. So it's personal insurance, private property, SME in the Nordics, and then the UK business as a whole that's driving that. And this is very, it's important to say that this is very much about how we've positioned these products and how those markets are developing. So we've, just to take one example, we've developed a digital SME product that is also getting more and more tractions as SMEs are getting more and more used to buying insurance digitally. So that's a typical, actually, we have both. We've developed product and we have an increasing market for that product. Then in the UK, we just have a really good business model for the price comparison website, and that's what's driving the growth. So it's those areas. It's not us being sort of aggressive on price or anything like that. It's proposition led.
And finally, just to clear all misunderstandings, this growth has nothing to do with Top Denmark. That has always been fully consolidated, meaning that you have always having all their results. So Ono is the only thing, and we can see that on the bars you are taking away, and then it's 10%. There's nothing Top Denmark, just so everybody is sure of that, including myself.
That's exactly right. We haven't fibbed the numbers. Top Denmark has been fully consolidated into the premium since 2017. The 10% that we call organic here really is organic. I spent a long time calculating that number, and then we have the Una transaction, which adds about 1 percentage point or a little bit more on top.
Perfect. Thank you to you, Sammy, and thank you for the audience asking questions and listening in. And may everybody have a nice day.
Thank you.